Welcome to the Legacy Lounge, Douglas Dickey.
Thanks, Deborah. Appreciate you having me.
I'm going to call you Doug because I know that that's routine, but I really want to thank you for coming to share your background, is some information about your firm today. You started your accounting firm in 1984.
Correct.
And you are a CPA who has grown not only an accounting firm, but a consulting firm. And so if you could just take us back to when you started and just a quick evolutionary tour.
Sure. My granddad was a CPA, and so I grew up around the business and actually worked in his firm during the summers I was going through school. And I had always enjoyed business. I was an entrepreneurial little kid. And he had seemed like a person who had a great deal of knowledge about business, because as a CPA, we get to go into people's businesses and they'll tell us or show us things they may not tell or show everybody else, because we get to see their books and they tell us what keeps them up at night. And so I learned some of that from my granddad, and originally went into public accounting not as to make it a career, but as a continuing education, because I felt like I could learn more about a greater variety of businesses faster than I could in any other occupation. And so that was my thoughts about going into school. But one summer when I was working at my granddad's firm, I believed that I was given my mission as to what my purpose in life is, and that was to create employment in small and middle market businesses, to create jobs. And so set about going into public accounting to learn more about what makes a business work and how does it work and what can you do to preserve capital and to be able to grow it and to create sustainability of jobs. And so that's been sort of my life mission. And it took me into a number of different areas in public accounting, but I went to work originally for a firm that I was employee number 21 in that firm. It was called Briggs & Vasilka here in Houston years ago. And I was with that firm for several years, and I went to work for another firm, Mello Cohen and Company, that was a CPA firm here in Houston. It also was good for buying and selling businesses. And then I went to work for an SEC RIA to be able to work with them on being their CFO or also structuring some transactions. And so it was sort of a continuing education process to learn more about how do you manage taxes in a business, because that's a capital erosion. How do you finance and buy and sell businesses, and then how do you be able to transition them? And so once I had gone through that process, I then hung out my own shingle and started into practice at that point.
But that's been 40 years. And
that's been 40 years ago.
And I really love the story about your grandfather, because it sounds like, not that he was old-fashioned, but there was a time when people spent more time deepening relationships and trying to find those pain points. And when you mentioned you help people and to find out what kept them up at night, those kinds of relationships last.
If you're in a service business and you don't have a relationship with those you serve, you're probably not in the right business. Yeah, my granddad was a special person. He was an accountant before there was an AICPA time frame.
Really?
Okay, and so he had to go back to school to get the education necessary to sit for the exam to become a CPA. And so in our world, it's a couple of generations, and these regulatory bodies that we have now weren't here, right? I mean, it was a different environment.
Very different environment.
And it was an environment that was, from a CPA standpoint, it was still the apprenticeship concept, where you actually go to work for somebody else and you learn the trade, you learn the mechanics of it. And the industry today still has that to an extent. Once you pass the CPA exam, you have to work under a CPA for 1,000 hours before you are actually eligible to receive your license. And so the industry still recognizes that you can't learn everything that you need academically, that there's some part of it that has to be learned on the job.
And how those 1,000 hours are spent, it makes a big difference. In your case, you spent it in a true mentoring capacity. Some people get really good at audit during that time frame, but may not see the relationship side of the business. And I have to believe that that's one of the reasons why your firm is in the top 1% of CPA firms nationwide, according to the AICPA.
Yeah, it really is. If you're trying to provide counsel for clients, right? I'm going to break our industry into two different components, right? There's a traditional accounting model that is really trained to be a historian. As an accountant, we write down what somebody else has done and we report it to stakeholders, whether it's shareholders, the IRS, or lenders, or the SEC, or bonding companies. So that's a rear look, right? That's looking.
Mirror.
That's right, because you cannot record the history until it's happened, right? So the traditional model of accountants is that you're doing compliance work and accounting work to make sure that you have accurate information
about what already happened.
Has already happened. And while that data is important, what's more important is the information that you can glean from that so you can be a more informed decision maker going forward. So we call it understanding our client's journey, establishing that relationship, not just as a human, but why did they do what they do? Why did they choose this business? They can go into any business they want. Why did they choose this one? So what brought them there? How did they go from where they were in the beginning to where they are today? And where do they want to go from here? What's tomorrow look like? If we can understand their business better, then we can be better counselors for them. We can be better accountants for them. We can be better tax planners for them, estate planners for them, succession planners. If you don't know your client's journey, then the danger is you're going to account for something wrong because you don't understand what they're doing. And you're going to give them advice in an area that's not really proactively planning for where they're trying to be.
And maybe that's why you've always described yourself as a proactive CPA firm, because you can't do anything about the past, really, except record it.
That's it.
But to help someone find the way and navigate forward is huge. How many people are in the firm now?
47, be 48 on Monday.
Wow. Do you have an official mentoring program?
We have a mentoring program that is not where it needs to be. We have an entire career path process that we put into the firm, and a lot of firms that are proactive and trying to grow talent are implementing these days. When I went into the profession, it was kind of a sink or swim. You got your information, you were sat down at a desk, and you figured it out, and you went forward. Well, those days were also a lot simpler than what they are today. The tools we have to work with software and the processes and systems and the complexity of tax and business laws are just different. And so we actually have gone through, and we call it POD, process optimization and documentation, where we've written down the step-by-step processes for being able to do everything we do in our business. Then we have a learning management system we call DRDAU. It's a training process, and where we take that information developed in the POD process and put it into a learning system so people can transfer that knowledge from one to the other. Those are both supportive to what we call a career path, which is basically like, think of a curriculum in college. You had your first semester freshman year, second semester freshman year, and so forth, right, as you go through. And going from an intern to a staff 1 to a staff 2 to a senior to a manager or director or partner is like going from the first day of college to graduate school. You have to have knowledge about technical things.
Even a PhD at the level that you guys plan.
Yeah, so it's not something you're going to learn overnight. And so we've developed those courses for being able to help our employees advance at twice the industry rates.
And a lot of firms who've developed that degree of process procedure are much larger firms. You must be very disciplined about your commitment to technology and your commitment to really looking at each of those gradations.
It is true. I mean, for a 50-person firm, it's unheard of to have that sort of thing. But we're not building it to be a 50-person firm. We're building it to be a 100-person, 200-person firm, right? And it also goes back to, I think, a difference of our industry. If you look at traditional CPA firms, all CPA firms, let's start there. There's about 50,000 CPA firms registered with the AICPA. Of that, 84% of them have 5 or fewer employees.
80%,
84%, 5 or fewer. So that's just a solo practitioner with some folks working with them.
Support, and it might be seasonal, and
That's right. If you go up to 10 people, it's about 92% of all those CPA firms. So it's very much a mom and pop kind of business. When you get into the 20 and 30 person firms, you usually have 4 or 5 partners with 4 or 5 workers under each one. So what you really have is an aggregation of practices sharing cost resources. You don't really have an integrated practice. And we refer to that as the practice of accounting. And that's the practice model where people build their individual book of business and they have employees and they work from there. We refer to ourselves as being in the business of accounting, not the practice of accounting. Clients come into to DRDA, they should have access to the resources of all the firm, not just 4 or 5 people. And so we each have different areas of expertise, and it's imperative that you integrate those areas of expertise so the client gets the best resources they have available to them at that time for whatever their issue is. And that business concept has also taken us down these paths of what is required to create sustainability. You have to have knowledge capture. You can't depend on your knowledge coming back in the door the next day, because as a service provider, all we have is our knowledge and our processes and our relationships with our clients.
Well, and integration like that, means as much developing a culture in your firm and developing governance.
Yeah.
I mean, even at a lesser scale, I find that, firms tend to grow when they have stronger governance and culture.
Yeah. I think any organization or family does, if you think about it. If you have chaos or if you have dysfunctionality, then people aren't working together. So you have to have alignment. Well, if you have 4 or 5 people really sharing resources as opposed to actually having a common mission that they're trying to accomplish and a common vision they want to achieve and a common value set, if they don't have those and they don't have an integration of how they work together, then they're really not working together, right? That's the practice.
As a founder and a leader, what do you think are some of the keys to that leadership? It sounds like communicating that message often, the vision, the mission.
Yeah, I think it is the cultural part of it. You can get very smart people to learn difficult things, but will they work together as a team or an organization to be able to bring the collective mind together, right? None of us know it all.
So if you have someone who seems to know it all, they may or may not be a team player. Some people like to keep those secrets to themselves.
Yeah. Have you ever watched a sport team where you had a bunch of all-stars who were in it for themselves and not working together? And the mediocre team would usually beat them because they would work together. It's the same concept in business. All of us have strength and all of us have weaknesses. What's important in an organization is that we all accentuate our strength and support our weaknesses so that we collectively are better than we are independently. That's how a team wins as opposed to individual.
And sometimes it takes respecting differences.
Of course, we're all going to have different opinions, and we're entitled to those opinions.
And different views. But, I noticed that your doors open at 8 a.m. And maybe that's changed since I read your website, but yet sounds like there's a strong work ethic, but you have fun.
Yeah, I don't think work ethic and fun are mutually exclusive. We'll have people there from 7 o'clock in the morning until 7 o'clock at night. We have some that come in earlier and some that comes in later. The public hours are that 8 to 5 like normal businesses, but you have people that come and go at different times. But even though we have areas of work that are perhaps complicated and areas of work that are usually time sensitive because there's a due date for something at almost every 15th or every month. The reality is you still have to be humans and you still have to have lives. So the industry, to an extent, and probably deservedly so, certainly from the larger firms, has really become sweatshops in some instances. I mean, the CPA firms, the larger firms, it's not unusual to work 3,000 hours or 2,800 hours. That's just a ridiculous amount of time. And people cannot be as productive when they're in their 60th and 70th hour of a week as they were when they're in their 40th hour.
And sometimes no one even knows because they may be the only ones there.
Yeah, so it's just not an appropriate way for people to work, and it's not a sustainable way for people to work. That's why the turnover is so high at those firms.
You talk about the impact that you want to make in the firm as making a difference every day. And that goes along with your culture too, doesn't it?
It does. If you look at the Zoom calls we have, there's a tagline that's behind all of us. It says, "Working to improve your future, not just account for the past." And that's the distinction. Is that yes, we can do your accounting, we can do audits and compilations and reviews, and we can help you with payroll. We can be third-party administrators for being able to administer your plans. But you probably didn't go into business because you had a burning desire to file another tax return or get an audit. These are things that are required to be able to either get capital for the audits on things, or from a tax planning and compliance standpoint, it's to preserve your capital to take advantage of whatever the law allows us to do legally from a tax planning perspective. those are in support of what your overall mission is as a business.
Well, and you got a lot of that because I was thinking about what made you interested in accounting, but you answered that earlier really with your grandfather and his ability to see the pain points and try to look forward and look for clients.
His firm was in a little town called Monroe, Louisiana. It's in the northeast corner of Louisiana, and in small towns you have to have continuing relationships with people because you're not going to hide from anybody in small towns. And so all of his clients were personal friends and acquaintances. They'd grown up together to a great extent. Mm-hmm. And so talk about knowing somebody's life journey, they'd known about it all their lives, right? And because of that knowledge, he had insight about what needed to be done or what could be done within the family dynamics of those businesses because they were all family-owned businesses. And so, the relationship part of it and understanding your client and the client's journey is foundational, I think, to good service.
That knowledge is power to help someone.
Sure.
I read on your website that you believe in providing the best solutions for clients, be it ours or someone else's.
Yeah.
And that really resonated with me because it sounds like collaboration is a key component.
There is collaboration is absolutely a key component, and the other side of it is none of us know it all and can do it all.
Okay.
And if we're going to be a trusted advisor, if a client comes to me and it has a problem, and while I can do it, I know that somebody else can do it better. Mm-hmm. Then I have an obligation to let the client know that I'm not the person that should be doing that. They should go see somebody else because they're putting their trust in me. And if I'm doing something that benefits me, potentially to their detriment, then I just violated their trust. So I think that you have to have an idea of what do you do well? Do as much as you can, as well as you can. But to the extent that you can't do it, then you find people or you surround yourself with others that have skills that you don't, that can help your clients, that can help your firm and your organization, so that collectively we come up with a better solution. The collaborative approach is absolutely foundational to the approach of service. One of our industries, but not just ours, most professions, the problems I think they have is that the siloed mindset. All too often you'll have CPA firms and law firms and financial advisory firms and risk management firms that are working independently with a client. They're each having conversations about what's going on with the client. The client's got problems or questions, they'll ask each of us, and then we can say, I can help you with 1, 2, and 3, but go talk to your attorney about 4 or 5 or your financial advisor about 6 or 7. And now we're forcing the poor client to go around and repeat their story multiple times and try to interpret through their lenses what we each individually are interpreting through ours, right? We all have a history and a knowledge that we screen things when we hear and we come up with what we think would be a solution based upon our knowledge base.
Absolutely, right? But it is like having the clients, they're forced into a game of telephone because they're interpreting and then trying to reinterpret. If you don't
and it's never going to come out
together,
right at the other end of the line, is it?
We often talk to clients about, if you don't have a meeting once a year with your team of advisors, then something's lost in translation.
You've been in this business for a while. You know that. How many times have you had those kind of meetings, and that was the first time that the attorney or the CPAs had ever met each other?
It's amazing. Because it's not standard stock for us, but it's surprising, but it happens.
It should be required because ultimately we need to understand the same journey the client is on. And then we each need to look at what we see are issues that need to be addressed, and then collaboratively with the client, we need to come up with a priority of what needs to be addressed because small businesses don't have an unlimited amount of resources. They can only take on so much and change at one time. Which one's the most important? To de-risk the business, to improve the quality, and make it sustainable going forward.
It's interesting because in the investment and private wealth management community, there's so much discussion about the term fiduciary responsibility. And having hired and having worked with CPAs my entire professional career, I think that CPAs had kind of a corner on fiduciary long before everybody started talking about it. It's always been important, I think.
I think
not that there aren't silos there too, but
there clearly are. But you're right. I mean, I think as a profession, it's an ethical profession.
It is. Their code of ethics is strong, and I think they were fiduciary long before the word kind of became so trendy. When I met you, we were at a tax institute, and you gave a presentation. And it was so exciting to me. And I wanted to invite you here so that if there are other business owners or people watching this, they would have some idea of how you approach the whole business. And you were talking about, service organizations.
Yeah, sure.
And I wonder if you can tell us more about that.
Sure. The idea that you're talking about is something referred to as a management services organization, or MSO is the acronym that's used. The probably better descriptive term is a central resource center for businesses. But where it came about was really from an asset protection perspective, that it's not unusual for entrepreneurs to have multiple operating companies. You may have a manufacturing company, a distribution company, a retail company, you may have a real estate owning company. And so we rightfully set up separate legal entities to be able to hold these different activities, with the idea being that as activities take place in a business, should liability come to one gets sued, you don't want to infect the others with the liability of one, right? So it's done as from an asset protection.
The separation of these entities.
That's it. So each one's in their own separate legal entity. And that's exactly the right thing to do. But if you're on the other side of the coin and you're trying to attack it from a forensic accounting standpoint on going in to try to pierce the corporate veil, there's basically three ways in which you can pierce a corporate veil. The first is an error of creation. There's some kind of flaw in how it was established, meaning you set up an entity with the Secretary of State, but you never adopted the bylaws or the organizational minutes or operating agreements. So you did not fully comply with the statutes, therefore you're not entitled to the protection of the statutes. Okay. The second one is an error of transfer. I set up this entity to hold real estate.
Well, hang on a second. And by saying you're not really eligible for the protection, you're meaning you're pretty much bare from a liability standpoint.
That's it. If it's not properly formed, then it doesn't exist. And so it's back to being a sole proprietor. And so there's no veil there at all. I can just walk in and take the assets.
Okay.
That's exactly it. The error of transfer is we establish the entity to own titled assets. Titled assets are things like real estate or rolling stock, automobiles, equipment, trains, planes, boats, that sort of thing. But if I go check the title is never transferred inside. It's still in the individual's name. So it's like building a fortress, but leaving your assets outside the fort. I don't have to break in the fort. They're already out there. I can just take
Great
them.
analogy.
Yeah. But the third and most common is an error of operations. An error of operations is a commingling. It's where you have one entity providing a benefit for the other without adequate consideration being paid. As an example, say I've got one company that's the manufacturing company, and it needs to go deliver something to a customer, but its truck breaks down. Well, I've got a construction company over here. It's got a truck that's sitting idle. I just put that driver from the manufacturer inside the construction company truck, and I go pick it up and I deliver it. Well, did the manufacturing company pay for the truck rental? Were they covered under the insurance from a commercial standpoint on being able to use it? So Exxon would not provide free equipment to Shell, right? They're not being treated as separate. And so to the extent that I can see that there is assets being used for one without adequate consideration, without an agreement outlining the nature and scope of the relationship.
Good point, because that's another way you could protect is by having that written agreement.
Exactly.
Okay.
Then I can go, as a plaintiff, I can go to the judge and say, look, Your Honor, why should I, as an outsider, be held to a higher standard than people who are actually owning and operate these businesses? They're not treating them as separate. Why should I be held to a higher standard? Take my judgment against company number one and walk it across to company number 2, 3, and 4. And so over the years, the courts came up with a 4-pronged test to determine whether they would recognize a separation of liability between related parties. And the 4 tests are, first, there has to be a separate legal entity. Well, that's not a problem. You can have as many entities as you want.
Set up as many LLCs and file those
as you want.
Yeah.
The second is there has to be an agreement outlining the nature and scope of the relationship. Normally, when you go engage somebody for services, there's an engagement letter. When you go borrow money from the bank, there's a promissory note that says here's the terms under which you're going to repay. If I'm leasing equipment or real estate, there's a rental agreement of some time. So anytime you have arm's length relationships in business, there's usually something that outlines the nature and scope of what each party is supposed to do. So it's just another point of trying to look at this as being
in how many situations that you enter with business owners that have a number of entities, how often do you see these service agreements enforced?
Less than 2% would
Oh
be
my
approved.
goodness.
It's
I was
extremely
giving people
rare.
the benefit of the doubt in my mind, but
Yeah,
it's rare.
extremely rare.
Okay,
It is.
thanks.
And then the third thing is it has to be a fair value transfer. You can't charge your sister company $1,000 for something you charge somebody else $100 for, or vice versa, and say
yes.
that's arm's length. It's not economically the same.
Fair market value.
That's it. And then the fourth criteria is actual performance. You have to actually be able to deliver in accordance with that agreement that outlines the nature and scope with the goods or services, right? And so that's what the courts have
Can you
looked
spend
at.
a minute on that again,
Sure.
on the performance? What do you mean by that?
That means I can have an agreement in place that says I'm supposed to be doing A, B, and C to get X number of dollars. If you pay me X number of dollars and I've only delivered A and B,
Then you've underperformed.
that's right. I've not
You're
met
not
the
delivering
criteria.
the service
That's it.
that the agreement.
Am I really delivering it? Because it can't be on paper. It has to be operationally that way.
Okay.
Okay, and so that
Paper alone is not enough here. Yeah.
it has to. The paper has to support the economic reality of the operations. And so
Great.
what we're talking about
Very clear.
is sort of restructuring the operations. In an MSO or a central resource center concept, you establish a central entity that owns commonly utilized resources. Commonly utilized resources can be things like people, equipment, real estate, intellectual property, licensing rights, capital. Those are all assets that can be deployed in multiple businesses. So you put those assets in a central resource center, the management services organization. Think of that like the hub of a wagon wheel, right? It's the center of it. Then you have a spoke going out from the hub, and to the end of each of those spokes, out at the rim, there's another operating company out there, another asset holding company. So now you have this circle surrounding the commonly utilized resources. If I have separate legal entities, which I do because there's a separate legal entity for the management services organization, and I have an agreement outlining the nature and scope of what that central resource center, the MSO, is to do for each of the operating companies, I have a fair value transfer for the actual goods or services that are being delivered between the MSO and the operating companies. I now have separate and distinct operating entities from an asset protection standpoint to be able to protect that from that error of operations. So that's the original foundation of why that concept came about. Is it's just not unusual. I mean, major corporations will have themselves broken up into multiple different operating companies by regions or by areas or by staffing or things. And it's for the same reason. It's just
And I
good
would think
business.
larger companies are more inclined to have that than maybe
No
entrepreneurial business owners.
No question. I mean, our market is small and middle market businesses. The SBA defines small businesses as having 250 or less employees. And so in a small...
Is there a revenue test, something that, I mean, obviously people can set up a lot of companies and maybe they're not profitable, maybe one is and the others aren't. Is there a certain minimum revenue because it is going to some trouble to make certain that everything is tick and tacked.
Where it comes into play generally is when you have income that's flowing out to the individuals in excess of $1 million for the profits of it. So you don't have to be that big of an organization to be able to produce that. It can also be a situation where you can have a large amount of debt that would perhaps be better structured in one entity than another. So there could be a host of reasons that you would want to look at that structure.
Okay. So the right profile would be someone who does have multiple entities.
Yes.
And they really want to centralize resources, as you said. But it would be profits around $1 million.
Yeah, I mean, they have resources they want to use in multiple operating companies.
Great.
Right?
Okay.
And they have enough profits that it's worth somebody suing them to go after their assets on a thing. That's right.
Okay.
And then they want to be able to grow capital from there.
Great. And when you're doing that, I imagine it takes gathering quite a bit of data because you're looking at multiple organizations and titling may be different and ownership structure between them might be different. So gathering that data, and I know that there's no solid answer on this, but generally speaking, how much time should a business owner plan, before they can get something like a consolidated system in effect?
Here's sort of the timeline and the process to go through on
Great,
that.
thanks.
What we're talking about is restructuring somebody's operations, right? We're talking about
Right.
putting in place a new entity and restructuring where assets and activities are held or undertaken. So that's not something to be done lightly. And so the process is we get the last 2 years' tax returns and financial statements for each business,
Okay.
most recent current year financial statement, a personal financial statement if one is available. Then we ask them questions about how much money they make versus how much they consume each month for their living costs, how much business-related debt they have, and other questions as far as benefits for life insurance and disability or uncovered prescriptions and procedures, that sort of thing. What I'm trying to do is get my head around where's their income coming from, how is it taxed, how is it held, how is it earned, and where are they deploying it, right? Because if you watch their business and then you look at their personal financial statement, you can generally see where the assets are earned in their business and where they're deployed on their personal financial statements, right?
Understandable.
And so that gives me a picture of their current state, if you will. Then I take a look at, okay, if we were able to take and restructure, whether it's their executive team, whether it's their assets, whether it's all their employees to make it a full employee leasing organization, what do we need to do to achieve a better tax or financial result than how they're
So
currently
you're
structured?
looking for tax efficiencies.
I'm looking for tax, I'm looking for asset protection, I'm looking for purchasing power. There's basically three components that we look at. Is first, I want to protect what they have. To me, the first order of business is don't lose what you've got. So protect what you have. The second one is there a way to be able to restructure income streams in such a way that we can achieve a better tax result if we utilize a mix of different types of entities, whether it's flow-through entities like partnerships or S corporations or C corporations or trusts. I mean, there's a number of
So
different
evaluating
structures.
the type of entity becomes very important.
And that's why I wanted to see the tax returns to see how they've been filing as far as taxation
Sure.
is concerned.
And deductions. And there could be opportunities for getting additional tax deductions if the structure is done correctly.
That's right. Individuals, partnerships, S corps, LLCs that are disregarded, C corps, estates and trusts, they're all taxed or tax reported in some fashion. And there's pros and cons of each of those. So rather than just simply using one structure, there's advantages to sometimes putting multiple structures together. Using trusts with family limited partnerships, you use that for estate planning all the time, for CRATs and CLUTs and SLATs and all the other acronyms that comes along with the estate planning world. We're using different structures to achieve a different result. Well, you have a right to do that from an asset protection standpoint, and you have a right to do that from a tax standpoint as well.
Very interesting. We talked a little bit earlier, and we're not going to go into detail on this, but one of the areas that you're spending more time on is the whole question of business valuation, succession, and helping companies take a look at that. We have a fairly aging population, number of people that are looking at exiting businesses, and it's a real challenge.
It's a real issue for our society. I mean, if that definition of small businesses, that 250 employees or less, that makes up 99.9% of all the business in the United States.
Still, those are current stats.
Current stats from the SBA.
Interesting.
Over 46% of all jobs are within that group of businesses.
Almost half.
Since 1995, 62% of all new jobs have been created by that segment of society. So it's the fastest growing segment of our economy from an employment standpoint. So when you're talking about small businesses generally don't sell for as high a multiple as larger businesses or public businesses. And the predominant reason is because they're not as sustainable. Generally, when you have a small business, you have a handful of people at the top that have most of the knowledge, most of the relationships, and have most of the resources to be able to create the ongoing activity of the business. So if you want to be able to grow a business, you have to replicate that. And it takes a lot of investment of time and energy to bring in place people that can take the knowledge out of one person's head and put it into another so that it can be transferred and therefore be sustained. And so we work with small and middle market businesses on developing that infrastructure necessary for being able to we call succeed or transition, right? To be able to succeed management. So if you want to retire in place, you want to be able to own the business and continue to harvest the earnings off of it. You can do that because you're no longer having to work 60 and 70 hours a week, because you've got a leadership team that's capable of being able to make operational decisions going forward. If at the end you want to transition, meaning you don't want to be there anymore and you want to sell it, then a business that is sustainable and owner independent will sell for a higher multiple than one that's not. So the whole value growth and value creation requires that you de-risk a business. You don't have exposure that could put it out of business, and you improve the quality of the business. It's akin to when a private equity group comes in to look at buying a business. They go through a due diligence process to first confirm knowns. Is what they told me true? The second one is to confirm, determine material unknowns. What did they not tell me that could be a problem? Mm-hmm. And then the third point is to determine, okay, if I take over the operation of this business and the ownership of this business, where do I go from here to increase the value of it to make my investment worthwhile? Well, business owners need to look at that themselves. They need to look internally and say, okay, how do I take this business and reduce the risk that something bad can happen to it? How do I grow this business in such a way that I improve the quality of the business so that it's more sustainable and it's not susceptible to a few people leaving the business that could...
Or one major client leaving.
Exactly.
Or any number of SWOT analysis that you can do. And sometimes they just may decide that they don't have the management team to sustain the business. Yeah. And then it's really about a liquidity event. And I would imagine in that case, you're helping them evaluate how they can best position themselves in the marketplace.
And that's that you're 100% correct. And that's what you've seen actually in most of the professions. You've seen a lot of merger mania, where you have a lot of law firms and CPA firms and others that are merging up. They're going into larger businesses. That's really their only exit option because they've not created sustainability. And it's the same thing from any other type of business. If you've not created internal sustainability, then your only exit is to sell it, and you're going to sell it at a reduced multiple because the business is not the same without you, right? You've not created that sustainability.
Consolidation becomes the only option for you, and it is interesting when that happens, you're really outsourcing your succession plan to your acquirer.
That's it. And there's other problems that comes along with it. You have a number of the larger CPA firms, top 200 firms in the country, that have gotten there because they've been merging other firms. Well, law firms as well. It's the same way, so it's not just CPA firms. Well, what you've seen here in the past 8 to 10 years is private equity groups coming into public accounting. And same as they've done with healthcare and dentistry.
Private wealth management.
That's it. And part of that reason is when you bring these firms together, now you have a lot of buyouts for retiring partners. But their books of business, if they're not continuing to grow organically, then at some point those businesses are going to sell or merge or go out as it is. So you have a dying asset because it's not internally sustainable, right? And so you're sitting there with these firms that have large revenues, but they have large debt because buyouts of partners and principals creates a cash flow obligation. And so private equity is coming in and refinancing those to take those out to get the balance sheet right on those firms, introducing the business concept of accounting as opposed to the practice of accounting, and taking those firms to go
And there's
forward.
A financial consolidation and then integration culturally and from a process and procedure. I mean, I think a lot of mergers happen where they're all in a different business together.
Deborah, you're 100% right. I mean, the easy part is putting companies together mechanically and legally and financially on paper. It's the human culture part of it. It's the processes and procedures. It's the software. It's what's right and what's wrong and what's not acceptable. What's the quality of delivery of the goods or services that's acceptable within that organization. That's vastly more difficult than the financial combination.
As in all things that you've done, I would imagine you'll have a very even hand and that you'll be able to help a lot of people solve amazing pain points.
We
in
hope
the
so.
succession area.
We hope so. I mean, it's part and parcel to our mission.
It's a big trend.
Yeah.
We can't leave, of course, without talking about a little bit of prognostication about where income taxes and estate taxes are going to go and what impact this election you think may or may not have.
Yeah.
What are the hot items on the income tax side? You think about dividend taxation, for example.
Yeah. There's a whole host. I mean, each time there's a presidential election, as a firm, we put out a piece on the tax platforms of the candidates so that our clients have an understanding about what each candidate's tax picture would look like.
And their philosophy and...
Exactly. And we as a firm are looking ahead so that whichever one wins, one of them's going to win. What can we do to help our clients plan, right? So we can be responsive to what's going to take place. And so this campaign that we're watching right now has been the slowest to develop on substantive topics like tax like that. There's been a lot more discussion about the character of each candidate than there has been about
Would you say
the
that's true, that really it's been very little substance
very little
on how tax reform will be treated?
Yeah, and I think it was a brilliant concept on one of the parties and not a very smart one on the other parties that goes through. But they're fundamentally different platforms. When you look at the Democratic or Republican platforms from a tax perspective, they are very different platforms. But I think it is a good indication of the priorities of the two parties on things. From the Trump camp, there really hasn't been much change from a tax perspective. There's not really been a whole lot of discussion about it. He's wanted to exempt tip income, Social Security, tip income from being taxed as Social Security. He's mentioned taking corporate income tax on C corporations from 21 to 20%, and basically keeping everything that was a part of TCJA, Tax Cut and Jobs Act, that was enacted at the end of 17, because that was predominantly his tax platform, right? So there hasn't been a lot that's come out of there. In the Harris campaign, it's a significant difference, and it goes back to the political differences, I believe. From a corporate standpoint, on C corporations, the Harris tax platform is recommending corporate income taxes go from 21% to 28%, so a 7% increase. They've also proposed...
What is the average corporate tax rate worldwide?
Yeah. For developed nations, the average corporate tax rate is 15%.
Thank you.
And that was part of what was the intention of TCJA, was to bring the U.S. more in line with multinational companies, so our companies would not have to leave the United States because they were at an economic disadvantage because of our tax system. Didn't get to 15%, but they got to 21%. The other component of the Harris campaign is there's this, let me call it a stock buyback tax, where it's public companies oftentimes will take excess cash and they'll buy their stock back into Treasury from the marketplace. It's a way to be able to take those excess capital, excess funds, put them back out into the marketplace, allow some of their investors to harvest some of the gains off of it, and to actually drive up the value of their stock because there's less shares outstanding, presumably, in the business, right? And so it's kind of like a stock split concept, if you will, for being able to help drive values up. Well, there's been implemented a 1% tax to the corporations that do that to the extent that they pay it out. The Harris campaign has recommended that go to a 4% tax for being able to do it. Yeah, 400% increase on the cost to be able to repurchase that capital for companies. In addition, they've looked at the global low-income tax concept. The GILTI tax has been implemented for companies that go into lower tax regimes where they have to pay at least a minimum of a 10.5% tax back to the U.S. That's proposed to go to 21% under the Harris campaign. From a capital gains perspective, they're wanting that to go from 20% to 28%. From an individual tax...
Is that strictly on the Democratic side, or do you think both of them are looking at some cap gains increase?
I think it's on the Democratic side at this point, because if you look at the Trump tax plan, it's a capitalistic concept. Reduce the tax rates, which should drive up profits, which should drive up capital to create growth. So the idea of creating economic growth is to create more capital in the public market to go use it. The Harris campaign is more about a socialist concept of taking capital from society to the government so the government can then redeploy it through social programs. The idea of going from 21% to 28% puts our multinationals back at a disadvantage in the marketplace on a global basis. Individual tax rates, they're recommending that they go to 39.6% for families making more than $450,000 a year, married, filing, joint couples. That same couple would be in a 32% tax bracket today.
Okay.
In addition, they're recommending that the net investment income tax go from 3.8% to 5%. But it also be subject, and it's not just about passive income anymore. It would also be about capital gains that would go for like the sale of a private business that you've been operating in.
Have you seen anything further on taxing unrealized gains from the Democratic platform?
There's a couple of provisions on that. There's a supposedly, the term is called a billionaire tax. It's actually on people who have a net worth of greater than $100 million rather than $1 billion. But it's a 25% tax on the appreciation of those assets.
Whether they sell them or not.
And that's also a part of their component from an estate tax standpoint, is to have it valued. Basically, it's like you sell it at the date of death. Instead of a transfer, it's deemed to be a gain, which means you have to know the basis, right? Because a gain is the difference between the sales price versus what your basis is. Well, I don't know if you've ever helped somebody go through an estate that, it's an 80 or 90-year-old person that may have bought property 70, 80 years ago. Go find that document to determine what the basis is, or the improvements on that property during that period of time that would increase the basis. It's literally an impossible process.
It is. So basically it goes to taxing the spread between the basis and the value is so huge, you're paying tax on almost everything.
And you're taxing at basically ordinary tax rates. So it's actually a bump in the estate tax. There's a number of people that have written articles about the belief that is an unconstitutional tax, that the government does not have the right to tax something that hasn't taken place. If you look at our tax system...
Well, because it'd be very difficult, wouldn't it, if you pay tax on something that appreciates dramatically and then the next year... it falls in value.
Yeah, I mean, it's
you don't get to take a deduction, right?
Yeah, it's the valuator's full employment project, right? I mean, you think about it. You're talking about having to take everybody's personal balance sheet and determine what's the fair market value of every asset: your home, your vehicle, not just your stocks and bonds.
Really,
yeah,
I didn't
it's
know.
Your business itself, and so every year you have to have a valuation of your business to determine what the fair market value of that business would be.
Guaranteed employment.
And any time that goes up, 25% of that growth, you're going to have to pay now in tax. It's a confiscation of capital from society to the federal government in turn to be able to get it deployed. So the Democratic and Republican platforms on tax, I think, are very similar to the platforms from a social standpoint, and it's just a different approach of how you achieve either equality in the socialist concept or stimulate economy from a capitalist standpoint. But the tax systems very closely mirror those platforms.
In the estate side, what do you think the probability of the sunset, which actually takes a $13.5 million exemption today and cuts it in half in January of 2026? What do you think the probability of that is?
That's a great question, and one everybody's wrestled with.
I know.
My gut tells me it's gonna happen, and here's why I'm that pessimistic, I guess, on things. Is that we talk a lot about the presidential election, and rightfully so. It's a very powerful office. But, tax legislation has to happen in the Congress, and then it gets approved by the president. Neither body can unilaterally change our system. So what level of dysfunctionality will we have in Congress versus presidential, right? Is one party going to take over both houses and the presidency, or will we continue to have a dysfunctionality like we've had for the last 10 years where we can't have agreement on what's in the highest and best interest of our country? And so to the extent that we don't have functionality between those bodies, then the only thing that's going to happen is we just continue with what we got, which means January of 2026.
And that's the path of least resistance, really, without there being a lot of them going to the mat.
Or having to make a public vote to approve it or disapprove it. Either.
Yeah. Okay.
And so my belief is it's probably going to happen. And so we need to prepare for that to be the case and understand what the implications will be. So, we're already gearing up on estate planning for people.
Well, what would you say to people that say, well, I have till January 2026? What?
You don't.
Worry?
You don't. I mean, first off, you've got a lot of things that have to happen to get the right plan in place.
Absolutely.
Then you have to have the legal documentation. Remember that? And then you have to have that transfer of the assets. Remember that error of transfer I was talking about previously? That comes into be on estate taxes as well. And then
a lot of people don't realize that there's an actual change of titling that has to happen when you're creating these new entities. And, you can't just, snap your fingers and that happens. It has to be paper, just like the agreements you were talking about earlier in the Master Service Organization.
Exactly.
So there is a timeline on that.
And it actually has to be implemented. It's like that specific performance I was talking about.
Specific performance, right, the last test.
It's the same thing from an estate standpoint, because it's a restructuring of somebody's wealth. And so you don't have it. And it takes, to me, that estate planning concept takes longer than a business restructuring concept, because there's a lot more emotions involved with it when you talk about family dynamic.
In my experience, it takes at least a year.
Yeah.
So if people are thinking they can wait until the fourth quarter of 2025, it might be too late.
Yeah.
And I think there's a shortage of specialists like yourself and in private wealth, and even in the estate planning community. They're not getting young people saying they want to be estate planning attorneys. They want to be litigators or M&A attorneys.
Exactly.
And so there's a shortage. And so there really isn't enough disciplined advisors to help people.
There's no question. I'll tell you how drastic that is. The valuations, anytime you have under the current law, anytime you have a gift or an estate transfer, it's done at fair market value. So you do have to have a valuation at that point. There's not enough valuators to be able to evaluate all the assets.
Interesting.
I'm a member of an organization called the Abundance Collaborative. It's sort of a think tank of people to help with philanthropic endeavors from a tax perspective. We're doing tax-related structures with charitable giving. And there's one of the attorneys that's in there is a pretty well-known estate planning attorney. And he's got a practice in Nevada that's pretty significant. But larger firms, he's already been approached by 2 larger firms to basically hire all of his capacity through the end of next year, because they don't have enough attorneys with advanced estate planning capabilities to be able to do that. And so I think you're going to see that taking place. There's sort of a grab bag. It's taking place
It's
right now.
not that everyone's working on Rupert Murdoch's Nevada Trust, right? It's something, it's a general shortage.
There's a lot of us that have a lot less net worth than Rupert does, but still have estate planning
But they'll have
issues.
estate tax, right.
That's right.
I've not been able to find out what the probability of the property tax deduction being reinstated. Somehow it was in the legislation for the sunset for that to happen. What do you think the probability of that is?
Yeah, that's a great question as well. The SALT tax, state and local tax issues, right? We're limited to $10,000 per year. Yeah. And it's one that it predominantly impacts higher tax states, right, which are predominantly Democratic-based states. So you would think that there would be a lot of discussion on the tax platform about reinstating that. There was about a year or so ago, but it's been pretty radio silent at this point. And so I don't think it's a hot topic for them right now.
So it may just be ignored.
I think it is, and quite frankly, I think it's awful for both parties to do that. I mean, I think that if people pay a tax to a governmental agency, there should be an ability to be able to deduct on it. So there's not this double tax for both federal and state level to that extent. You at least get some relief for it. We do that with foreign taxes paid.
True.
Why shouldn't we do that from our own state's perspective?
And it's hard enough for young buyers to buy homes without having some tax relief there.
It's incredible. If you look at the $450,000 of income, you have a 39.6% federal rate. You have a 5% net investment income rate, the Obamacare rate, right? So we're up to 44.6.
Right.
You have another 2 points that comes in now for the additional Medicare tax. We're at a 46.6% federal tax rate. If you're in a state like California, that's a 13.3% state income tax rate. We're back up to 60% tax for people above $450,000 a year. That's not a super wealthy person. It's a good income.
And it may be the highest in our professional careers.
Yeah, it's approaching it. Incredible. It certainly is.
Well, I have no doubt that the clients of DRBA Doug Dickey and firm are in good hands, and I wanted to, have the opportunity to learn more about you today, and hopefully we have a chance to work together to take away some pain points for clients.
Deborah, I appreciate you bringing on and your kind words as well. Look forward to working with you.
Thank you, Doug.
Thank you.